Welcome to the Daily Brief, where I'll go over the action in the market for Friday, March 24th, and then we'll see how things look for Monday, March 27th. We had another bounce. Over the last 2 days, we've had some up days, but it hasn't been even as much as 1% of recovery. However, the technicals are showing a little bit of improvement. Now we have to see, can we build on that? But at the same time, in Friday's session on the up day, we did have a decrease in volume to below average. Just a little bit of housekeeping to take care of. The supplemental video that I usually do on Sunday night or Monday morning, it is being merged with other videos, and I have some charts to show you today of that. And then from April 22nd through the 11th, I will be traveling. My hope is to post at least the daily video updates. I may try to post some other videos if I'm able to do that. Also, I'm thinking of launching a podcast. YouTube now has that feature available. Those of you that like to only listen to the audio version, that's going to be a bit of a hindrance because I use so many charts to look at. So what I'll be doing is I'll put a PDF of all the slides and charts that I use. There'll be a link in each podcast description. So be looking for that in the near future. Let's go back and talk about what happened. Right at the open, we did have a lower open, and prices fell down below S1 at 39.09. Then we rebounded a little bit as the market tried to figure out what it was going to do. Prices then rebounded again up to the unchanged level and to the daily pivot at 39.58. Then we closed above the daily pivot. We were up 0.56% on below average volume. So 2 up days, below average volume. A little bit of a warning sign with that. Our technicals, they're negative overall, but because we've had the 2 up days, they're showing some improvement. Now we need to see what will happen from here if the market can build on this with also an increase in volume. The markets are still pretty fixated not only on the inflation and interest rate scenario, but also this whole banking problem. It's like every day we're just waiting for something else to come out. And there was some news on Friday that I'll deal with here in just a moment. Here's the intraday chart showing how we had a lower open. We came down to S1. That was the low for the day before bouncing back up above the 200-day simple moving average. We were then able to get back above the unchanged level and get above the daily pivot and closed above the daily pivot for the day. Here's a look at value and growth. Growth really underperformed in Friday's session. Here's the closing value showing how both were up, but growth did a lot worse than value on a percentage basis. The same thing is true with the mid caps as well as the small caps. Here's the overnight and intraday chart for the SPY. Before Friday's session, we were bouncing around a little bit higher, but then as the overnight session really came and caught in gear, we really started to drop. Europe really had some problems in Friday's session, and that dragged the S&P futures down. However, that did influence the opening of the market on Friday, but then we were able to bounce up out of that after the European markets closed. We closed just a little bit off of the high, and then after the market closed, we drifted sideways with the futures prices still continuing to advance. We'll see if that can carry over into Monday's session. What are some comments that we can make? Growth did underperform value in Friday's session. Just a little bit of a warning sign, but not enough to really shift things back over for value to be in the lead. The big news that hit the opening of the market and the European session is now there are concerns about Deutsche Bank because they're having to pay a lot more for their default insurance. But then after the market closed in Europe, that's when things really picked up in the U.S. Some statements came out saying, no, there's nothing to see here. So at least for right now, it looks like this is under control. And also on a geopolitical front, the U.S. has retaliated in response to that downed drone that happened last week. We'll have to see if that escalates anything between Russia, Ukraine, or Russia and the U.S. On a short-term basis, the Stochk RSI has now become extreme overbought. That's a very touchy indicator. So for it to go extreme positive is not really a surprise. That's the only one right now. The dollar was up and interest rates were down. This gave a little bit of support with interest rates going down to stocks. We still have the 30 to the 5 that's now normal as far as its yield curve, but we still have all of our other yield curves that remain inverted. Sentiment is still negative. We ticked down a little bit. We had been at 34. After Friday's session, we were at 33. Our trend is still negative. The red line's on top. It's weakening because it's below the moving average. It's also below 20. I've changed our bias to positive with the 2 up days, but I've kept our momentum at mixed. There's still some negative things happening that could have a real impact on the market, and the fact that we're seeing a decrease in volume is a concern. We also have a lot of positive backdrops that I'll go through and show you, but we're just waiting to see if that can ignite the market and really take it higher, but it hasn't happened yet. Economic reports that came out. Durable goods were down 1% on a month-over-month basis. They expected durable goods to be up 1.6%. The last time we had this report, they were down 5%. If you take out transportation, durable goods were unchanged on a month-over-month basis. They expected it to be up 0.3%. Last time it was up 0.4%. The IHS Market Services PMI came in at 53.8. That's a little above 50, so that shows a bit of expansion in the economy. This is the preliminary reading. Last time we had this, it was at 50.6. And then we had the manufacturing PMI come out. This was a little under 50, showing a bit of contraction. It came in at 49.3. Last time it was at 47.3, so a little bit of improvement, but still a contracting economy. Looking at some Isabel Net charts from their blog, this chart is just suggesting that the earnings estimates are still ahead of economic realities. This red line on the chart is continuing to go up. These are forward estimates that are going well into 2024, but that's not really what we're seeing on a real life basis. So there's a lot of folks thinking that this red line needs to come back down to get more in line with what is actually happening. This chart just shows the massive influx into money market funds. And in fact, they set a new record high at over $5 trillion just in money market funds. Looking at how the Fed fund futures curve has changed, 2 weeks ago, we were up pretty high where we thought we were going to top out at a little over 5.5%. Now this has really dropped because the Fed came out at their meeting and kept the terminal rate at the same level. That was seen as positive, or that maybe they're getting close to raising interest rates, and so we saw a real drop in this figure. But as we're seeing more and more economic weakness, both the blue line and the purple line continue to decline. Another chart just says that households currently are allocating 40% of their total assets to equities, and that's what most people do. They invest in stocks. It's kind of an American thing to do. The light blue line here just shows debt. That means buying bonds, and that's lower, where 17% on this chart are allocated to cash, whereas 40% of households invest in stocks. This is also showing how the money market fund yields and U.S. bank deposit rates have really gone up as the Fed has been raising interest rates. The green line is the money market yield, and that's why they're becoming a lot more popular. You can get a risk-free return with those. The pinkish reddish line is the Fed funds target rate, how it's been going up. The dashed line right near the bottom are money market deposit accounts, still not really giving much of a return. And then the blue line right near the bottom are what you can get for savings accounts. Looking at the purchase index for housing, it's starting to go back up. That's the dark blue line on here, and you can compare it to other years, where we're still quite a bit below what the sales rate for real estate has been over the last few years. Another thing that people are starting to worry about is stagflation. That's when you have very high inflation but no economic growth. That's still in the lead of what people think are going to happen over the next 12 months. Way down at the bottom, you have the dark blue line. These are people predicting an economic boom. It's not very popular right now. The Goldilocks, which means everything is just right, that's also pretty low right now. And then secular stagflation, which means it goes on for a long time, that's also pretty low. Every day, Real Investment Advice puts out blog posts. Usually I refer to their newsletter, which comes out once a week. I go and look at these blog posts every day. Sometimes it doesn't seem real applicable to what we're trying to analyze with these videos, but Friday's post did seem to have some good information. The headline says, recession indicators say the Fed broke something. A chart down below is just showing how we've really bottomed out and we're starting to go back up. These are tightening standards. So banks are getting a lot more strict with who and how they're willing to lend money to folks. And this also coincides with other charts that we've seen, that banks are getting a lot more strict with their standards. The next chart also goes with some explanation. This says, as shown, M2, which is the money supply and a measure of monetary liquidity, is still highly elevated as a percent of GDP. And this is still processing its way through the economic system. And there's a real massive deviation from what we've seen in the past because of all the stimulus that came out during all the COVID lockdowns. And at some point, we'll revert back to the normal price because we've really deviated away from that. And the fact that this is happening is why a lot of people are yelling recession. So the red line on the chart is just showing M2 as a percent of GDP, how it really went up after the COVID plunge and now is starting to come back down. Here's another look at M2 as a percent of total consumer credit. When the Fed starts injecting money into the system, that can really help things as far as people not taking on as much debt. Well, we're seeing that reverse right now. So with inflation, people are having to go more into debt just to get by in their daily lives. The next chart shows the economic composite index against the GDP growth rate. They're both declining and they're both below the dashed line, suggesting that a recession could be in the future. Here's another one showing that same output composite index against the LEI with a 6-month rate of change, suggesting that a recession may happen in the future. And this looks at the S&P 500 annual change against the liquidity measure, where both are continuing to decline. This looks at that same economic output composite index against the Fed funds rate. As these rates are going up, the economic composite index also goes up. Well, what we're seeing right now is this composite index is going down as interest rates are continuing to go up. What they're trying to do in this blog post is put forth the thesis that when the Fed is raising rates, that actually is better for the economy because usually the economy is robust and it's doing better. When they start to lower interest rates, that might provide some short-term support for stocks, but ultimately it does a lot of damage to the economy because things are slowing down. Here's a look at long-term real interest rates and then different things that have happened. You can pause and look at this. We're dropping below right now, but we don't know what's really going to happen with that. But other times in history, when they've really brought rates down on a real level, that means that inflation is factored in. That's usually when some pretty bad things happen. And this chart goes all the way back to the late 1700s. This next chart compares Fed funds against the S&P earnings growth rate, showing how the growth rate for the S&P is going down as interest rates have been going up. And as long as interest rates continue to go up, that will still impact on earnings growth. Right at the end of the blog post, they say historically, periods of Fed tightening have never had a positive outcome on earnings. And it likely won't be this time either. This is particularly the case when the Fed breaks something. Well, we're seeing some of the banking problems now. That's being attributed to what the Fed has now broke. While this time could be different from an investing standpoint, I wouldn't bet my retirement on that view. The idea that, this time is different, it'll work. We know things that we didn't know before. Well, a lot of times this could be different, ends up being par for the course, as things rarely ever change that much. Then John Murphy also had a post. Every Friday he comes out with an email, and subscribers to stockcharts.com receive this email. I just have some of the text that he talked about, and I highlighted what I want to cover, and I highlighted pretty much everything that was said. What we're watching also are falling commodity prices because this is a sign that rising interest rates may be pushing the economy into a recession. Falling commodity prices start to push bonds higher, which is what we're seeing right now, as the economy weakens. And bonds outperform stocks in the early stages of a recession. We're seeing bond strength right now. Is that going to lead us into a recession? Then we're also battling with the inverted yield curve, which is another warning signal that a recession may happen. The recent plunge in stocks is a direct result of the Fed raising rates so fast over the past year and is another warning of potential economic problems ahead. In a recession, stock prices start falling with commodity prices while bond prices rise. That's from the intermarket analysis. And if you know much about John Murphy, even though other people have talked about intermarket analysis, he wrote a book that really made this more popular. And I base a lot of my intermarket analysis on what I've learned from him. We also had the latest reading from the American Association of Individual Investors. They are still extreme negative as the market has been having some difficulties. that could be positive for stocks. But we spent a large part of 2022 and now 2023 below this 20 level, giving us an extreme negative reading, and it hasn't produced a real upward thrust, at least yet. I delayed showing these charts because they take a while for this information to update, but the weekly jobless claims did fall and were below the moving average, suggesting that the employment situation is still pretty strong. The continuing claims are still about on the average here with the moving average, but they're actually picking up slightly, and that could be more dangerous. The first chart shows weekly jobless claims. That's people that have filed for unemployment for the first time. If people are still on unemployment week after week after week, that means they're having a difficult time finding a job, and that could also suggest some economic weakness. Overall, we're watching the employment situation pretty closely because that's still strong. I'm hearing lots of news about all kinds of layoffs, but it's not really working its way through to the data that we're seeing yet. Looking at the Ulcer Index, we've dropped below the moving average, showing how fear has now decreased. Here's the VIX, showing how we did tick down on the line chart and the bar chart with the up day. Here's the VIX of the VIX, showing how volatility has also been decreasing over the last couple of days. The equity put call ratio, after giving us an extreme reading above 0.8, we're now down at the 0.65 level. And when we spike up and start coming down, that quite often will give some good support to stocks. Then looking at another fear gauge, we're ticking down just a little bit. We're chopping around overall with this particular fear gauge when we look at shorter term maturities and then compare it to investment grade bonds. Also, another economic fear gauge looks again at shorter term bonds and then compares it with the equal weight S&P 500 ratio. That has been spiking up just a little bit, showing that fear is still not far behind in the background. Looking at our trend, we're still below 20 with the ADX. We're below the moving average. It's trying to turn up, but it's still trendless overall. The red line's on top and declining, but so is the green line, but we would still default to negative because the red line is on top. The daily chart showing how volume was below average. We're still maintaining price above this downward sloping trend line. We're still above the 200-day moving average, which is also positive, but we're below the 50-period moving average. We're right in between the two. And here's a longer-term look at that same chart. We're just watching this to see if this trend line still holds. Our RUN ticked up just a little bit after giving us an extreme negative reading, so it's still negative overall, but showing a bit of improvement. Here's the Stochk RSI, which is now getting back into extreme positive territory. Then looking at our standard deviations, we're getting a little bit above the midpoint, so that's turning things back a little more positive. The Stochk RSI on a short-term basis is above 50 and advancing, so that's more positive. We're rolling over in the intermediate short term, but it's still above 50, and we're showing some improvement in the long short term. And again, the reason I use those strange terms is this is a further subdivision of the short-term time horizon. The force index is still slightly above 0, so that's somewhat positive. We're a little bit above the 20 exponential and simple moving averages, so that's slightly positive. We're still below the 50-period moving average, so in the intermediate term, that is still negative. And we're just about at the 100-period moving average. We're right on top of the exponential moving average and a little bit above the simple moving average. So also in the intermediate term, that's slightly positive. And our moving average tree shows how the 200-day simple moving average has been holding, and we're trying to get back up into some of these other moving averages. The Swinland Trading Oscillator, based on price and volume, continues to be positive. We turn back up and are above 0. We're still seeing a little bit of a mix, but turning a little more positive with our oscillators. The slope is still positive. The TSI is positive. These are our short-term oscillators, so they're positive. The MACD has crossed over and is positive. The PMO hasn't crossed over yet, but the PPO has, so that's positive. The longer-term oscillators are still negative, but they're turning up and could cross above their moving average in the next day or two if we see follow-through price action to the upside. Parabolic SAR remains positive with the dots underneath. The Chaikin Oscillator turned back up and is above the dashed line, so that is positive and showing some improvement. However, the vortex still has the red line on top and is advancing where the green line is declining. So this chart is negative. Ichimoku cloud, we're still seeing if we can get back up into the green cloud and then eventually break above that. So far, price has not been able to do that. Here's the PPO showing we're getting ready for a cross. We're pretty much on top of each other based on price, and we're just close to a crossover based on volume. The PMO study shows that the PMOs that are rising did improve. The buy signals also turned back up slightly, so that's showing some improvement, but we're still declining with the PMOs that are above zero. The BPI, after giving us an extreme negative reading, came back above 30, but then declined slightly in Friday's session, so that's a little more negative. And our broader range BPI is also showing a bit of a decline in Friday's session. The Chaikin money flow showing some weakness here, but still above zero overall. Balance of power has now crossed back above the dash line, so that's showing some improvement. TTM squeeze has not given us a blue bar yet, but is also showing some improvement, where the go, no-go system is now a dark purple, which is more negative, and we're just a little bit above the 200-day simple moving average. Looking at our short-term fib levels, we do have resistance at the 4004 level. We also have some support at about the 39, 35, or 36 level if we continue to fall. Longer-term fib chart coming back up to this 4,000 level, which is 39.98, but I rounded up to 39, and you could round it up again to 4,000. That's still acting as overhead resistance. In our longer-term fib chart, if we go to the upside, we have some resistance at 40.20. If we continue to fall, we have a double fib line at the 38.26 level. This is also part of the positive backdrop. The S&P big stocks are outperforming the entire equal weight S&P 500. The elder impulse system has switched back to positive for the S&P. The McClellan oscillator just a little hair above zero now, so that's turning back more positive. Our longer-term McClellan oscillator is showing some improvement, but it's still below zero, so that's negative. Summation index based on price is going sideways. Based on volume, we're starting to turn up. Sometimes the summation index based on volume, because it is calculated in a different way, it can be a leading indicator. New highs, new lows, we're still seeing an expansion of the new lows, but the 5 period is trying to turn back up where we're flat with the 10 period moving average. Advanced decline line showing a little bit of improvement, but based on price, we're still below the moving average as well as with volume. We're still negative with our advanced decline ratio, even though it's showing a little bit of improvement. Both lines are below zero. Accumulation distribution. This is positive. We're above an advancing moving average. And volume is continuing to drop off since it's been below average the last few days. Looking at the ratio from the financial sector to the S&P 500 is still showing a continuation of weakness. The bank ETF was up 2.25%. One regional bank ETF that we look at was up almost 2%, and another regional banking ETF that we look at was up over 3%. So we're seeing some bounce out of banks after they were really oversold. And then comparing the regional banking ETF to the financial sector, after falling back down, did show a little bit of improvement in Friday's session. First Republic was down another 1.36% to close at 1236. The Dow is still below the 200-day moving average, but maintaining price above this monthly support level. Where the diamonds continue to be neutral, the NASDAQ is holding up better. It was up 0.31% on the day after a recent golden cross, and we're still above this monthly pivot level. NASDAQ 100 also hanging in there, up 0.3% after a recent golden cross and staying above this R1 pivot level. The elder impulse system for the Qs has switched back over to positive. We do have overhead resistance at the 12.868 level. If we continue to go higher, that's about 20 points away from where we're at right now. Small caps also saw a bit of a rebound, up over 1%. And we look at on the next chart, we're back above this support level. We broke through it intraday, both Thursday and Friday, but we were able to close above this support level. The RSI is showing a little bit of improvement, but it's still negative since it's below 50, where the MACD continues to be in a downtrend. The small caps for the elder impulse system remain neutral, and the small caps compared to the S&P 500 continue to show weakness. The mid caps were also up 0.75%, but are pretty much chopping sideways. And the elder impulse system for the mid-caps is neutral. Looking at the home builders, tick back up a little bit with our relationship. So we're just waiting to see if any kind of positive or negative divergence happens with this chart, but we're not seeing that right now. The Copic curve gave us a recent buy signal, so that is positive. And the praying bottom fisher has now given us a buy signal as well. Looking at the yield of the 10-year bond, we continue to drop. We're down at the 3.38 range, where bond prices continue to break out to the upside. Looking at our long-term trend analysis, we're still not really seeing anything resolved here. Price is still above this declining trend line on this weekly chart. If we really fall below that and if the MACD rolls over, that might suggest that this breakout was a fake out. As long as we stay above this trend line, this breakout still looks legitimate, and at some point we're hoping that price will then break to the upside. An update of our possible positive scenarios. Saw a little bit of weakness, but the cues to the S&P are still strong. Seeing discretionary a little bit weaker. Large cap growth to large cap value is still strong, even though some weakness developed in Friday's session. Looking at our growth to value ratios with the large, mid, and small caps, a little bit of weakness after Friday, but still strong nonetheless. This is another concern. We're still below the zero line with our 50-period exponential moving average of new highs minus the lows, because on this next chart, this black line continues to be below zero. The longer it's below zero, the more the red line will remain negative. And then after spiking up with the 2-year yield and then falling back down, sometimes that gives support to the S&P. We're just not really seeing that now. And we're also looking at the staples to S&P 500 ratio. We're working off this major spike. If another spike does develop, we may work off that one as well. What's our outlook for Monday? We're possibly turning more positive with our technicals. And I have to say possibly, because lower volume, a real indecisive market, a weekend where who knows what news is going to break. It's really hard to be optimistic right now. We have to be very cautious. We don't have any economic reports coming out on Monday. The whole list of geopolitical events with the banking situation being more at the forefront. Looking at the Stock Traders Almanac for Monday, tend to be positive overall. The Dow's up 61.9% of the time. The S&P's up 57.1% of the time. The Nasdaq's up 66.7% of the time. So we do have some positive seasonality for Monday's session. And then the whole rest of this list are positive backdrops that I really only focus on when we're seeing some real strength in the market. This whole slide will then change once we go into April. We are on trading day 19 in March, where we're seeing a little bit of a decline with the dashed green line here. That's the S&P during a pre-election cycle. So our scenarios can't really go with the down one, even though our technicals are still negative overall. They are showing some improvement, but we're not trending. Can't really go with the up one either because we're not trending and things are still looking negative. So we continue to go with the sideways trend because the ADX is below the moving average. It's weakening. It's below 20. The red line's on top, so it is negative. So what is the conclusion? Overall, the S&P is possibly improving. How's that for real decisive? In the short term, we are showing some improvement there. We could be getting better in the intermediate term. Long term, we're still positive because we're above the 200-day simple moving average, and we've had a recent golden cross. Thank you. I hope you found this helpful. Over the weekend, I will be preparing the weekly video, the intermarket analysis video, and the deep dive video. Have a great weekend, and I will talk to you in the next video.